Hello and welcome to another financial analysis video with me, Moed Amin, and Ted Wayman, where we on this show help you improve your financial acumen, financial analysis, and we analyze the financial statements of well-known famous brands in order to help you become a lot more astute and savvy when it comes to your financial analysis and helping to read actually financial statements. So today, we're going to be looking at John Lewis Partnerships. Now, John Lewis is a well-known British brand. They are a large employer in the UK, about 80,000 employees. And actually, what's interesting about this business is that they are, although they're a bunch of department stores, they also own a brand called Waitrose, which is an upscale supermarket in the UK. Actually, it's kind of the largest employee-owned business. So essentially, the employees own the company. They're involved in the decisions that are made in this business, and their ownerships are held in what's called a trust. Now, we're not going to dive into detail on this today. That's not the purpose for these videos, but you can certainly have a look at that if you're interested in either working for a company like this or investing in them. If you are going to be a private investor in a business like that through vehicles and trusts, or even if you're thinking about selling to a company like this, it's worth probably noting their investment and ownership structure. Before we go into the finances, one quick thing to note about this business is at the time of this recording, which is the 14th of September, the next day, which is the 15th of September 2022, they will be releasing their half-year results. Now, we're not going to go into that today. The purpose for this is just to help you become a lot better at analyzing financial statements so that when you look at these future financial statements, you'll be able to draw some insights and understanding much faster and more accurately. We're going to be looking at the set of audited annual reports, which is backward looking. But however, you can look at the future reports as well for yourself. And this video will help you do that. So let's get to it. Ted, let's share with our viewers and listeners what we have uncovered about this company and kind of walk them through how we went through that process.
Absolutely. So hi, Moed. Good to see you, and welcome to all of our, welcome back to all of our subscribers. Welcome to any new viewers. Please don't forget to like, share, and subscribe, because if you like, share, and subscribe, then you'll get notified about your videos. This is, of course, a request from one of our viewers. So Nuke wanted to see Waitrose. In fact, I've had a few other requests as well. I couldn't find them, but somebody's been emailing me and contacting me via LinkedIn asking me to look at John Lewis Waitrose. So somebody very, very persistent out there, this is for you. Just to note, it says John Lewis and Partners. Little point for Moed introducing with 80,000 employees. They are in fact partners, so they don't consider themselves to be employed by the company. They are partners within that organization. So slightly different structure than we normally see, and that's why we're not going to be talking about share prices because the shares are not publicly traded. Effectively, this is a company which is a limited liability partnership rather than a publicly limited a company. Okay, so that's a kind of, and as Moed said, that that's kind of all about the sort of the technical structure, but we can still find their annual report and accounts. Here they are online, 2022. So very easy to search for and find these numbers. And as ever, we are going to whiz through all of the information that tells you who they are and what they do and why they do it and where they're going and what their strategy is, etc., down to the financial statements. So here we are. We're on page, if you're looking for this, page 86 of their financial statements. And this is for the year ended 29th of January. 2022. So they finish just after Christmas. Christmas typically will be their kind of their biggest part of the year. So they'll do their big part and then they will close their accounts and then get ready for the next year. So rather than closing, a lot of companies we see close on the 31st of December. For these guys, it's a little bit close to Christmas. And also you've got things like, New Year's sales coming in as well, and the January sales. And they really want to get all of that out of the way before they close their accounts. So what are we seeing here? Well, first of all, we can see the top line is their revenue. So here we see their sales, and we are dealing in millions of pounds. So you're looking at about 10.8 billion, which is a small increase on 2021. Cost of sales, cost of things that they're selling, and that's about 7.4 billion, which is in effect 68% of their revenue, leaving them with a gross profit of 32%. Now, 32% isn't actually that bad. So 32% looks a reasonable margin, especially in retail. Typically, if you look at people like Tesco, they're much lower. So Waitrose is a very high-end brand, which means that we're paying more for good quality products, or sort of top quality, rather than the kind of the discounters like Lidl and Aldi down the back end, or the kind of the mid-market like Tesco and Sainsbury's, for example, and Morrison's. So these guys are very much positioning themselves at the high end, and they're making a pretty good margin as a result. The big problem for these guys is really this number here. So their administrative and operating expenses are very high, and effectively just wipe out any profit. So you end up with an operating profit of almost zero. So on a 10.8 billion turnover, these guys are making just over 100 million in profit, which is 1%. And you'll see in the previous year, 2021, still with a pandemic hanging over us, they made an operating loss of 360 million. And the reason I say this is an issue is because of this line here, because they have got debt, which they've got to service that debt. They've got to be able to pay the interest, and their interest bill is 155 million. So if you're making a profit of 118 million and and your financing cost of your debt is 155 million, basically you can't afford your debt. Big issue last year. I think this is more kind of distorted by the hangover from the pandemic, so we probably can kind of slightly discount that. They won't have had there was lots of lockdowns, lots of people staying home for Christmas, for example, weren't able to go out, so there would have been a sort of subdued amount of sales, and you can see here that actually even since then they've managed to kind of knock a significant amount off their overheads. So while the sales were relatively flat, cost of sales relatively flat, they've managed to reduce their overheads, but still they're not where they need to be in terms of that profitability. And as a result, they are making an overall loss for the year. There we go. Our overall loss for the year, 67, nearly 68 million pounds. So less than the loss in the previous years, but they are still loss making. And this has been a very profitable company in the past. They've made profits, and the partners, all of the people who work there, share in that profitability. So they all have a vested interest in the profitability of this organization. So things not quite going to plan for Sharon White, who's the new chairwoman who's taken over from Charlie Mayfield. So let's go look at their balance sheet, see what's going on their balance sheet. So the non-current assets, here are the non-current assets. These are the things they need to run the business. Biggest number there, property, plant and equipment, suggesting that they're going to own some of their stores, and that's going to be the stuff that's in the stores as well. And they also have these things called right of use assets. So basically we can add those two numbers together. Right of use assets is a bit like the photocopier. If you've bought the photocopier, it's going to go in here, and if you've got the photocopier and a hire purchase contract, it's going to be in here. This what we call right of use. So 5.3 billion of non-current assets, things they need to run the business. Inventories, 655. These guys do a lot of kind of white goods, so they do kind of washing machines and dishwashers as well, and a lot of clothing and department stores, as well as food. So you're going to have some sort of they're going to have eggs, which will move quickly, but they'll also have sofas or TVs, which move very slowly in there. Trade and other receivables is relatively low, as you'd expect from a kind of retail store. If you go into and buy something, you're going to probably buy it on you're gonna buy it on pay cash for it or buy it on your credit card, but they will have some payment plans in there as well. And then they've got a reasonable amount of cash, 1.4 billion. So that cash flow, that cash balance looking reasonably comfortable there. Looking at the liabilities, we can just compare the total assets to the total liabilities. So we can see their liquidity doesn't look an issue. And don't forget that, some parts of that business, some parts will be kind of negative cash flow. They'll have to pay for a dishwasher before they sell it, typically, but then others will have a positive cash flow, i.e. they will receive the money from selling an egg before they pay the farmer. So that's going to kind of help from that liquidity perspective. But liquidity doesn't look an issue. And in terms of the current the liabilities, if we just scroll down, we look at the sort of the big picture. In the current liabilities, we can see the trade and other payables. So this is what we owe to our suppliers. And a quick back of an envelope calculation suggests that it's taking them 80 days to pay their suppliers. Now, I said that's a very back of an envelope calculation, but it gives you an idea. These guys are squeezing their suppliers for every day of cash flow. So if you're supplying to these guys, then you can expect some pretty tough negotiation. Their stock turnover is about 32 days. That sounds about reasonable. And their accounts receivable turnover is about 7 days. Again, that sounds reasonable because most of it will be payment up front. The other thing to notice here is their borrowings. So we're going to kind of take this number here, and then they've got the kind of you're looking at nearly $1 billion in borrowings, and then a very large lease liability. So a lot of that interest will be around. So those lease liabilities, which you can see some in the current as well, will sit sort of. That's what's funding the right to use assets. So in effect, there's a new statement that says that you've got to bring these onto the balance sheet. So in effect, rather than just saying, oh, we're renting a photocopier, we don't have to show it on our financial statements. What you can now see is that the photocopier is on the balance sheet, and the loan required to fund that photocopy is also on the balance sheet, and then they're recognizing the cost of that loan through the income statement as their financing costs. And as we saw, their financing costs are greater than their operating profit, which is a little bit of an issue for these guys. There's no other really big numbers jumping out at us there. A couple of, there's a few provisions, for example, a little bit of derivative financial instruments, which they'll use to manage risk, but nothing else really kind of, no real issues there. You talk about this share capital, so very little in terms of the actual share capital. This is kind of obviously owned by the partners, but this company is very much funded through retained earnings, and the retained earnings, interestingly enough, it looks like the retained earnings have gone up, which is a little bit bizarre for a company that has made a loss. So we might want to go and have a look at the movement in equity to see exactly what is going on there. So here's our kind of our movement in equity, and we can see the retained earnings. We're looking at the kind of the nearly the second from the last column, and we can see that the retained earnings. So here's the retained earnings at the beginning of the year. Here's the retained earnings at the end of the year. There's the loss for the year. And actually, there's a pension scheme remeasurement. Now, I don't know exactly what that kind of, what that suggests is that the pension scheme is in surplus, and therefore we can kind of, recognize that surplus through on this balance sheet. You'll notice in the previous year they had exactly the same, but it was the other way around. They had a negative. The pension scheme looked like it was underfunded, so to speak. So that's kind of accounting shenanigans. We kind of don't worry too much about that, but it really saying that this company, they're making a loss. They're not distributing anything to the partnership because they can't afford it, and the company is funded purely through the through these retained profits, and those retained profits are pretty healthy. So they have been making very, very significant profits in the past, and the partners have benefited from that. Last statement is the cash flow statement. We've got our cash generated from operations. Here's the kind of the net cash from operations. There's a little bit here in kind of share flow to kind of incentive plans for the partners, but these guys are generating cash, and you kind of expect that. So certainly supermarkets are very good at generating cash, so the Waitrose part of this will be very, very cash generative. As I said, they tend to sell an egg long before they pay the farmer for buying that egg. We then see the investment going on, and what you can see here is about 400 million of investment. Really, you want to focus on these numbers up here, because there's a little bit of a distortion. You'll notice there's a positive figure in the previous year of 240, and that's driven by the sale of short-term investments. So just so that we understand what's going on there. On the balance sheet, when we looked at the cash, you'll notice we said, look, they've got some cash here. Actually, what we should really be doing is using both of these numbers together, because this short-term investment is a bit like your or my deposit account. It's just where we park extra cash. So in effect, the previous year, they took all of the cash they had parked away and stuck it in their bank account. So it looks like it's a positive cash flow, but of course, really, from our perspective, it's just a reclassification. And then the financing activities, here we've got finance paid in respect of bonds. So this will be the finance costs. So this will be the cost of issuing debt, for example, the payment of capital element of leases. So this is kind of part of the lease cost. And then a little bit of inflow outflow borrowing. So while the previous year they managed to kind of increase their debt to help their cash flow, this year they have negative cash flow from their financing. So the net effect is that they are generating cash, but they are also using cash. A little bit of it is being parked into their deposit account, but the rest is effectively being used. But the cash is still reasonably constant. Cash at the end of the year, 1.4 billion. So no real issues from a cash flow perspective at the moment, or a cash in the balance. However, I guess the kind of the conclusion is that these guys are they're making a loss, and you can't make a loss forever, as we know. Their loss is in danger of making the banks nervous, and if the banks get nervous, then they start to say, well, you know what, we're not going to renew your loans, we're not going to allow you to refinance with us, you've got to go and find somebody else. And that starts to become a bit of a sticky. Now, I don't think these guys are anywhere near going bust, but the numbers are very similar. We did an analysis of Thomas Cook back in 2010, Moeed, and the warning sign there was Thomas Cook couldn't afford its debt. And we're sitting now, we're in a world where interest rates are going up, so that debt sitting on their balance sheet is only going to get more expensive. So these guys are going to have to cut a little bit more. They're going to have to really notch in a couple more holes on the belt, for example. They're going to really have to kind of scale down. So I wouldn't be surprised if we see some kind of restructuring going on, or some significant cost-cutting measures in order to return this company to profitability. It's got a great brand name. It's well trusted. It's well liked by the British public. It is premium. They're going to struggle. They are kind of never knowingly undersold, but Waitrose is a premium brand. So how hard it's going to be hit by the cost of living crisis and the kind of the energy issues that are coming remains to be seen. But there's no reason why they shouldn't be able to to steer a path and through these kind of difficult waters, let's put it like that, Moeed.
Fair. So hopefully that was useful for everyone. Like I said, we take these famous companies, we analyze their financial statements so that you can learn how to do this yourself and to become more financially savvy and build your financial acumen. So do leave a note in the comment section. And as Ted shared, this was a request. In fact, I would say more than 95%, maybe about 95% of our of the companies that we analyze are actually requests from you, the viewers. So if you're interested in the company, whether that's because you're thinking about investing in them or selling to them or even joining them as an employee and you want to understand their finances better, leave a note in the comment section and do leave some context behind why you're interested in this company. The more context, the more we're able to consider those aspects as part of the financial analysis so that it helps you. So do leave a note in the comment section. And until then, thank you, Ted. Thank you, everyone. We'll see you in the next video.
Catch you later, Moeed.